Bonds, debt, obligations. Bonds are simply IOUs where investors loan money to a government, municipality, or a corporation. For example, a state municipality will issue out bonds to raise money for the building of new roads. The money they receive will go towards paving those roads. However, bonds will have a maturity date, and on that date, the municipality will have to pay you back what you've lent them, also known as the principal. And for you loaning them money, the municipality will pay you interest. It's important to also understand the credit quality of the corporation or municipality issuing the bond. The U.S. government bond issuers are automatically labeled as highest grade or maximum safety. Credit quality is determined through bond ratings. Companies like Moody's will rate the financial strength of issuers. Now, a AAA rating is top of the scale. Moody's AAA. You must be wary of bond issuers with a weak rating who have a poor record of paying bondholders their interest and principal on time. Bonds that are considered non-investment grade are also called junk bonds. Bonds get an interest rate or a return called the yield. Each bond is worth something and has a market price. The bond yield and the bond market price move in opposite directions. Let me give you an example. If you bought a bond last year that yields 3% and interest rates moved up in the economy and there are similar bonds that now pay 4%, these 4% bonds will be more attractive than your 3% bond, and this will affect the value of your 3% yielding bond. Investors won't pay full price for a bond that pays 3% when they can go into the market and find bonds that pay 4%. Therefore, the market value of your 3% bond will decrease. Mutual funds, indexing, and ETFs. Did you know that there are more mutual funds in existence than there are stocks? There are more than 8,000 mutual funds, and mutual funds are investment companies that invest a pool of money according to the fund's objective. A growth mutual fund will have the singular mission of buying growth investments like stocks. The three largest fund companies based upon assets are Vanguard, Fidelity, and American Funds. Now, mutual funds have a portfolio or a collection of investments that are professionally managed on behalf of the investor. As an investor, you don't have to make the decisions on how the portfolio is managed. That's the mutual fund manager's job. Mutual funds are also diversified. A growth fund, for example, could buy hundreds of different company stock from different industries. This diverse mix of holdings will reduce the volatility or fluctuation of the mutual fund. Mutual fund investing is also convenient because it allows you to rely on professional management. Mutual funds are either load or no load, and a load is simply a sales charge. Sales charges pay for the marketing, administrative, and management team cost of the fund. The expense ratio is a cumulative number that includes all fees. For example, the expense ratio for the average load fund is 1.5%. Always take into account the fees when considering a fund. Over the long haul, high fees will add up and detract from the overall performance of the mutual fund. Now, load mutual funds are broken down by A shares, B shares, and C shares. A shares have a sales charge deducted immediately when you buy into the fund called a front-end load. The upfront load will reduce your initial investment by 5%, for example. So an initial $1,000 invested in A shares will be reduced to $950. Class A shares are mostly appropriate for long-term investors because relative to other shares, they've got the lowest annual expenses and 12b-1 fees. Mutual funds, whether load or no load, have annual expenses to them. The more you invest in a mutual fund's A shares, it'll allow you to take advantage of discounts called breakpoints. Now, Class B shares don't have an upfront sales charge like A shares. If you sell out of the mutual fund in less than 6 years, for example, you'll be charged a back-end load. The back-end sales charge is called a contingent deferred sales charge, or CDSC. The CDSC load usually will decrease over time, and many mutual funds will require that you've got to stay invested in B shares for typically 6 to 8 years. B share CDSCs drop year over year while you're invested. Once that time is up, the CDSC drops to 0 in most cases. B shares 12B1 or annual expenses are higher than A shares. Another important thing to know is that the B shares and their higher annual expenses will convert to A shares automatically after a defined period of time. The advantage of converting to A shares is their lower annual expenses. Class C shares usually don't charge a front-end load. C shares have a CDSC, but it's lower than B shares CDSC in most cases. In addition, you don't have to hold the shares for a 6-year period, for example, to reduce the back-end charge like many B shares. Usually the holding period is 1 year. Class C shares have the highest annual expenses of all shares, and you cannot qualify for breakpoint discounts. On top of that, C shares will not convert to A shares' lower fee structure like B shares do. C shares offer the least flexibility and the highest annual expense.